Ever wondered why some investors seem to effortlessly grow their wealth while others struggle? The answer lies in smart investing. Smart investing is more than just picking stocks and hoping for the best. It's a calculated approach to wealth creation, rooted in understanding financial markets, diversifying investments, and adopting long-term strategies. It's about making your money work for you, rather than simply working for your money. Consider the case of a successful investor. She doesn't merely follow trends or throw money at the latest hot stock. Instead, she studies the market, learns about various sectors, and understands the economic factors that influence them. She knows that the financial market is a complex web of interconnected systems, and she uses this knowledge to make informed decisions. Diversification is another cornerstone of smart investing. It's the financial equivalent of not putting all your eggs in one basket. By spreading investments across a variety of assets, sectors, and regions, investors can mitigate risk while still positioning themselves for potential gains. Diversification doesn't guarantee profits, but it can help cushion the blow when certain investments underperform. Long-term investment strategies are a key component of smart investing. While some might be tempted by the prospect of quick gains, savvy investors understand that wealth accumulation is a marathon, not a sprint. They're not afraid of market fluctuations, recognizing that over time, markets have historically trended upwards. They're patient, knowing that the power of compounding can turn modest, regular investments into substantial sums over the long haul. Consider again our successful investor. She didn't become wealthy overnight. Her wealth is the result of consistent, smart investing over many years. She understood the market, diversified her portfolio, and remained committed to her long-term strategy, even when the market was volatile. So next time you're pondering why some investors seem to have the Midas touch, remember that it's not about luck. It's about understanding the financial market, diversifying your investments, and adopting a long-term strategy. Smart investing is not about making quick money, but about strategic decision-making and patience. Investing can be a maze, filled with misconceptions that can lead investors astray. That's a statement that resonates with many, considering the various myths that surround the world of investing. Today, we're setting the record straight, debunking some common misconceptions, and hopefully clearing the way for your financial journey. First up, let's discuss the myth that investing is strictly a game for the wealthy. It's easy to assume that you need mountains of money to start investing, but that's far from the truth. Even with just a few dollars, you can start investing and growing your wealth. Thanks to technological advancements, there are now numerous platforms and apps that allow you to invest with as little as the price of a cup of coffee. So, investing isn't just for those who already have a lot of money. It's a tool to help you build wealth, no matter where you're starting from. Next up, the idea that investing is equivalent to gambling. This myth stems from the fact that there is risk involved in investing. But unlike gambling, investing is about making calculated decisions based on research and understanding of market trends. It's not a game of chance, but rather a strategic way to grow your wealth over time. And finally, let's tackle the misconception that investing is too complicated for the average person. Sure, the world of investing can seem intimidating with its jargon and complex charts, but the basics are quite simple to grasp, and beyond that, there are countless resources available to help you learn and grow. You don't need to be a Wall Street whiz to be a successful investor. With patience, education, and a willingness to learn, anyone can navigate the investment world. Understanding the realities of investing is the first step towards making smart investment decisions. So, let's put these misconceptions to rest and embrace the true potential that smart investing holds for wealth accumulation. Remember, everyone starts somewhere. With the right knowledge and mindset, the world of investing is your oyster. One of the most hotly debated topics in the financial world is active versus passive investing. Which strategy is the best path to wealth accumulation? Let's dive right in and shed some light on the subject. Active investing is akin to a hands-on approach. Imagine you're a chef, meticulously selecting each ingredient for your dish, paying attention to every detail. That's active investing for you. You or your fund manager handpick investments, buying and selling in an attempt to outperform the stock market index. It's like playing chess with the market, making strategic moves to stay ahead. On the other hand, passive investing is more like setting a slow cooker and letting it do its job while you go about your day. Passive investors buy into funds that track a market index and hold on to them for the long haul. It's a buy and hold strategy, akin to planting a seed and letting it grow over time, watered by the rains of patience and time. Each style has its pros and cons. Active investing, with its strategic approach, has the potential for higher returns. It allows investors to dodge downturns and capitalize on short-term price fluctuations. But it's not all sunshine and rainbows. Active investing requires time, knowledge, and often incurs higher fees due to frequent trading. Passive investing, on the other hand, is a more affordable and time-efficient approach. It's been proven that over the long term, most fund managers don't outperform the market, making passive investing a wise choice for many. But remember, no strategy is foolproof. Passive investing is subject to full market downturns, and it doesn't capitalize on short-term gains. So, you may ask, which is the superior strategy? Well, it isn't that black and white. The best path to wealth accumulation is not strictly defined by either active or passive investing. It's about aligning your investing strategy with your personal financial goals, risk tolerance, and time commitment. Think of it this way. If you're someone who enjoys the thrill of the chase, has time to dedicate, and doesn't mind a little risk, active investing could be your game. If, however, you prefer a hands-off approach, have less time to dedicate, or prefer a less risky route, passive investing might be more your speed. Remember, investing is not a one-size-fits-all scenario. It's about finding the balance that works for you, tailored to your unique situation. And no matter the strategy, remember that patience is a virtue. Investing is a marathon, not a sprint. Whether you choose active or passive investing, the key is to remain consistent and patient. So, keep your eyes on the prize and let your investments work for you. After all, Rome wasn't built in a day, and neither is wealth. Ever heard the saying, "Don't put all your eggs in one basket"? This perfectly encapsulates the concept of diversification in investing. When it comes to smart investing, diversification is a strategy that can help mitigate risk while potentially enhancing returns. But what exactly is diversification? Picture a well-balanced meal. You wouldn't want to fill your plate with just one type of food, right? Similarly, diversification is about spreading your investments across different asset classes such as stocks, bonds, and real estate. The idea is not to rely on a single investment or sector for returns. By diversifying, you're effectively spreading the risk. Think of it like this. If one investment or sector underperforms, it's offset by others in your portfolio that may be performing well. This balancing act can help smooth out the inevitable bumps in the road of investing. Let's take an example. Say you've invested all your money in technology stocks. If the tech sector takes a hit, your entire portfolio could suffer. But if you had diversified your investments, with some money in tech, some in healthcare, some in utilities, and so on, a downturn in tech would be cushioned by the other sectors. Diversification isn't just about spreading your investments across different sectors, but also across different geographical regions. Investing in international markets can provide exposure to different economic cycles and opportunities, further spreading the risk. But remember, diversification isn't a one-size-fits-all strategy. It depends on your financial goals, risk tolerance, and investment horizon. A young investor with a high risk tolerance might have a more aggressive portfolio with a higher proportion of stocks, while a retiree might prefer a more conservative mix with a higher proportion of bonds. Also, diversification doesn't guarantee profits or protect against loss in declining markets. It's a risk management strategy designed to help you navigate the ups and downs of the market. Diversification is a powerful tool in the smart investor's arsenal, helping to safeguard against market volatility. When it comes to investing, patience isn't just a virtue, it's a necessity. Enter the world of long-term investing. It's not about the thrill of quick wins or the adrenaline rush of risky gambles. It's a steady, patient journey to wealth accumulation. It's about letting your money work for you year after year, decade after decade. Let's talk about the power of compound interest, often dubbed as the eighth wonder of the world. Imagine you invest $1,000 in a venture that promises a 10% return each year. At the end of the first year, you've earned $100, bringing your total to $1,100. Next year, you're not just earning interest on your initial investment of $1,000, but also the additional $100 you earned from the previous year. That's the beauty of compound interest. It grows, not linearly, but exponentially. Your wealth doesn't just increase, it snowballs. Now let's paint a broader picture. Suppose you invest $5,000 every year in a diversified portfolio with an average return of 7%. In 10 years, you've invested $50,000. But thanks to the magic of compound interest, your investment has grown to more than $70,000. Fast forward to 40 years later. You've invested a total of $200,000 over this period. But your wealth? It's not just 4 times your total investment, it's nearly $800,000. That's 4 times your investment and then some. This isn't a get-rich-quick scheme. It's a get-rich-slowly but surely plan. It's a testament to the power of patience, consistency, and long-term vision. But there's a catch. The power of compound interest works best when given enough time to work its magic. That's why starting early is so crucial. If you start investing in your 20s, you have several decades for your wealth to compound and grow. But if you wait until your 40s or 50s, you have far fewer years for compound interest to work its magic. In the realm of investing, time is indeed money. The longer your money is invested, the more time it has to grow. That's why long-term investing is such a powerful strategy for wealth accumulation. It's not about trying to time the market, predicting the next big stock, or jumping in and out of investments. It's about staying the course, riding out the market's ups and downs, and letting your wealth grow over time. As legendary investor Warren Buffett once said, "Our favorite holding period is forever." That's the mindset of a true long-term investor. Remember, the key to successful investing isn't timing the market, but time in the market. And that, my friends, is the essence of long-term investing for wealth accumulation. As we look to the future, what does smart investing look like? In the coming years, we can expect smart investing to be shaped by a few key trends. One of them is the rise of ESG investing. That's environmental, social, and governance investing. This approach considers not just the financial performance of a company, but also its impact on the world. As more investors become conscious of the role businesses play in society, ESG investing is poised to become a mainstay. Another trend shaping the future of smart investing is the increasing accessibility of investment platforms. Thanks to technology, investing is no longer confined to the suits on Wall Street. Now, anyone with a smartphone and an internet connection can get started. This democratization of investing means more people will have the opportunity to grow their wealth. But with greater accessibility comes greater responsibility. As investing becomes more prevalent, staying informed about market trends becomes even more crucial. It's not enough to simply ride the wave of a booming stock market. Smart investors will need to remain vigilant, keeping an eye on market trends, understanding the risks associated with their investments, and adjusting their strategies as necessary. The future of investing also promises more personalized investment strategies. With the help of AI and big data, investors will be able to tailor their portfolios to their specific needs and risk tolerance. This level of customization, previously only available to high net worth individuals, will become increasingly common. Let's not forget the role of cryptocurrencies and blockchain technology in the future of investing. While these are still relatively new players in the financial landscape, their potential for disruption is significant. Smart investors will need to navigate these waters with care, balancing the potential for high returns with the inherent risks. The future promises a lot of changes, but one thing remains constant: the principle of smart investing. That means diversifying your portfolio, investing for the long term, and always doing your homework. Smart investing isn't a static process, but one that evolves with the financial landscape. Ready to take control of your financial future? It's not just a question, but an invitation to step into the world of smart investing. It's an opportunity to become the architect of your own wealth, to build a financial legacy that lasts. Because, remember, wealth isn't just about the money in your account. It's about the freedom and opportunities that money can provide. It's time to break away from the traditional mindset of working hard for money. Instead, let your money work hard for you. Apply the principles of smart investing in your own life. Start with understanding your financial goals and risk appetite. Then, diversify your portfolio, invest for the long term, and be consistent. For those who are new to this journey, it may seem daunting, but don't worry, you're not alone. There are resources available to guide you every step of the way. Books, podcasts, blogs, online courses. The world is full of knowledge waiting to be tapped. And of course, there's this channel, the Billionaire Queen channel. It's not just a YouTube channel, but a community of like-minded individuals who believe in the power of smart investing. Here we share insights, experiences, and strategies. We learn from each other and we grow together. So why not engage with us? Share your thoughts, ask your questions. We value your perspective and we're eager to hear from you. Because at the end of the day, this channel is not just about us. It's about you. It's about your journey to financial freedom. As we wrap up, We invite you to stay with us on this journey. There's so much more to learn, so much more to explore, and we promise it's going to be an exciting ride. Stay tuned for more insightful content on investing. Remember, your journey to financial freedom starts here. Subscribe to the Billionaire Queen channel and share your thoughts in the comments below.